If you're self-employed and you're trying to lower your taxes, there's a good chance that some of what you're doing right now is completely useless. Not slightly ineffective, useless. And one of the things on this list is something most people are actually proud of. They think they're being smart, they think they're protecting themselves, and it is doing absolutely nothing for their tax bill. Here's the reality. Self-employment has a tax structure that punishes people who don't understand it and rewards people who do. The difference between those two groups is almost never income. It's knowing which moves actually change the outcome and which ones just feel like they do. Today we're going through 7 specific mistakes, real dollar consequences, real fixes, no vague advice, and we're starting with the one that trips people up before they ever file their first return as a business owner. Mistake number 1, mixing personal and business finances. This gets filed under basic bookkeeping advice and most people tune it out, but the consequences go much further than messy records, and the one most people never see coming is this. Mixing your money can erase your legal protection entirely. Here's what that means. One of the main reasons people form an LLC is to separate themselves from their business liability. But that protection is not automatic. It depends on you actually treating the business as a separate entity. If you ever end up in a lawsuit and an attorney can show that your personal and business money flowed through the same account, that you paid personal bills from the business, that the lines were blurred, a court can pierce that protection. Your personal assets are now on the table. The LLC did nothing. Beyond that, mixed finances kill your deduction accuracy. You can't cleanly identify what was a legitimate business expense when everything is tangled together. And if the IRS ever questions a deduction, a bank statement full of mixed personal and business charges is not a defense. People end up here because it's easier. Starting a business is overwhelming, and one less account feels like one less thing to manage. The fix takes one afternoon. Open a dedicated business checking account and a business credit card. Use them only for business. Never run a personal expense through either. Do it now, before the mixing gets worse. Mistake number 2, electing S-Corp status before your income actually justifies it. The S-Corp is probably the most talked about tax strategy for self-employed people online, and it is a legitimate strategy. But the way it gets presented, you think you should do it the moment you start making real money. That framing has cost a lot of people more than they saved. When you elect S-Corp status, you don't just flip a switch and start capturing savings. You take on real compliance costs, a separate corporate tax return, payroll processing for your own salary, more complex bookkeeping requirements. Added up, that overhead runs a minimum of $3,000 to $5,000 a year, often significantly more depending on your state and who's handling it. If your net profit isn't high enough to generate tax savings that meaningfully exceed those costs, you are paying more to feel like you're saving. The strategy works, but only at the right income level. Most practitioners put the starting conversation somewhere around $80,000 to $100,000 in net profit, though your specific numbers, state, and situation all affect that threshold. Run the actual numbers before making the election. The strategy is real, the timing is everything. Mistake number 3, paying yourself the wrong salary inside your S-Corp. And this one doesn't just go one direction. People get it wrong on both ends. Inside an S-Corp, you pay yourself a salary for the services you perform. That salary is subject to payroll taxes. Remaining profit comes out as a distribution, which is not. The gap between what you pay in salary and what you take as distributions is where the tax savings live. Some owners set the salary artificially low to push more money into distributions and minimize payroll taxes. The IRS knows this strategy and watches for it. If they determine your distributions should have been classified as wages, they reclassify them, and you owe back payroll taxes, penalties, and interest on all of it. The rule you'll hear everywhere, pay yourself 30% of net profit, has no basis in the tax code. It doesn't exist. Reasonable compensation is determined by what someone would actually pay for the services you're performing in your market, in your industry. That means comparable market data, documentation, an actual rationale, not a formula someone posted online. Those first 3 are structural mistakes, problems baked into how your business is set up. The next 4 are behavioral, and they're where people silently drain thousands every single year without realizing it. Number 5 is the one that hits hardest, because by the time most people feel it, the money is already gone. Mistake number 4, ignoring retirement accounts as a business owner. And here's the reframe that matters. This isn't a retirement planning mistake. It's a tax mistake, one of the most expensive ones on this list. Retirement contributions made through the right vehicles reduce your taxable income, and when structured correctly, reduce the income base that self-employment tax is calculated on. That's a double tax reduction most self-employed people never capture because they're not making the contributions at all. The reason is almost entirely psychological. People associate retirement accounts with employers. It's something HR sets up, something that happens automatically through a W-2 job. When you go self-employed, nobody sets it up for you, so it doesn't happen. But as a self-employed person, you have access to vehicles more powerful than what most employees get. A solo 401k lets you contribute as both the employee and the employer, pushing the limits significantly higher than a standard 401k. A SEP IRA is simpler to open and still allows meaningful contributions based on your net earnings. Stop treating this as a retirement decision. It's a tax decision. Open the account, know your contribution limit for your income level, fund it before the deadline. Every dollar you contribute is a dollar the IRS doesn't touch. Mistake number 5, skipping quarterly estimated taxes. And this isn't really a tax problem, it's a cash flow problem that disguises itself as one. And by the time most people feel it, the money is already spent. As a W-2 employee, taxes are withheld from every paycheck before you ever see the money. You don't miss it because you never had it. As a self-employed person, every dollar lands in your account in full. It feels like your money. Some of it isn't. The IRS expects you to identify their share and send it quarterly, and most people don't, not consistently. Not because they don't know they're supposed to, most do. But the deadlines don't feel urgent until they're missed, and the money has quietly been spent on things that felt reasonable at the time. Then April arrives, and the full bill is sitting there with nothing behind it. The IRS also charges underpayment penalties on top, so you're not just late, you're paying extra for being late. The fix is behavioral, and it's simple. Every time a payment hits your account, move 25 to 30% of it into a separate account immediately, that day. Label it your tax account and treat it as untouchable. It was never your money. Pay quarterly on the IRS schedule. This one habit eliminates most of the April shock for most people. Mistake number 6, confusing deductions with tax savings. This is the mistake that costs people money in a way that never shows up on a tax return because it happens in spending decisions made all year long. The phrase, "it's a write-off," has become one of the most expensive phrases in small business. People hear it and their brain translates it as, "this is free," or close to free, and they spend real money on that translation. Here's what a deduction actually does. It reduces your taxable income by the amount of the expense. You then save your marginal tax rate on that reduced amount, not the full expense. If your effective combined rate is 30%, a $1,000 deduction saves you $300. You still spent $700 of your own money. People buy equipment they don't need, subscribe to software they barely open, take trips they stretch to call business related, all because the tax benefit feels like it makes the purchase close to free. It doesn't. It never did. The test is simple. Would this purchase make sense if there were no tax benefit at all? If yes, buy it and enjoy the partial savings. If the only thing making it make sense is the deduction, you're spending money to save less money. Mistake number 7, either skipping the home office deduction out of fear or claiming it in a way that creates real audit exposure. Both happen constantly. Both cost people. There's a persistent myth that claiming the home office deduction flags your return for audit. For legitimate home-based businesses, that myth is outdated. Skipping a real deduction because of a fear that isn't grounded in how the IRS actually operates is a costly mistake. The deduction covers a proportional share of rent or mortgage interest, utilities, and sometimes depreciation based on the square footage used exclusively for business. On any meaningful lease or mortgage, that number adds up. The word that matters is exclusively. The IRS requires the space be used only for business on a regular basis. A desk in a shared room doesn't qualify. A dedicated room used only for work does. That's also where people overclaim. They apply a loose definition and claim spaces that wouldn't survive any scrutiny. There are two calculation methods. The simplified method is $5 per square foot up to 300 square feet. The actual expense method calculates the real proportional cost of the space. Run both. Use the higher number. If you have a legitimate home office, claim it. Every mistake on this list comes from the same place. Thinking about taxes the way an employee does when you're actually running a business. Employees don't have to think about any of this. It's handled for them automatically. The moment you go self-employed, that changes completely. The people who get hurt most are the ones who don't realize that shift happened. The good news is that none of this is complicated once you understand it. Most of these are fixable this week. And once the basics are solid, the advanced strategies actually work. Without them, you can spend years chasing moves that sound good and barely move the number. Did any of these surprise you? Let me know in the comments. I read them. And if this kind of straight, no-fluff financial breakdown is useful to you, subscribe. This is exactly what this channel is about.